We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Craig Hemke from TF Metals Report, joining me again. How are you today, Craig?
Tom, great to see you. Great to see you. I hope you're having a good summer.
It's been excellent, and it's always great to check in with you again. So I'd like to start. Of course, this past Sunday, August 15th, was the 50-year anniversary of Nixon ending the gold standard. So was this decision basically the biggest key to taking off the biggest constraint on the U.S. government at the time? And maybe as an aside, do you think that there was anything positive that came out of that decision?
Oh boy, how much time do we have, Tom? That's a long one. Let's work backward. Anything positive come out of it? You know, there are traditional economists, and the like, that say, look at all this wealth. U.S. is such a wealthy nation and all that kind of stuff. Yes, people live in big houses, right? The problem is the wealth inequality. I mean, the shift of the wealth, and the contraction of what we call, the middle income people and the lower income people, because with the wealth has come a significant deterioration of the value of the dollar or what the dollar can buy because they printed so many of them. And so, for some people, if you're some kind of, highfalutin, 8-figure, 7-figure Wall Street type flying, like in the movie Wall Street, flying first class and being comfortable, then you think it's great. And that's why those folks defend the system, until the system finally breaks. But for most people, you can trace this back even in the Fed's own research. Wealth inequality, income inequality. It's not the one party or the other. It's that detethering, that unanchoring, whatever the right word is, to sound money from 1971. And this was something that was inevitable. It's not like, oh gosh, I can't believe Nixon did this. If he hadn't done it, you had Britain and France that were kind of the final straw in 71, demanding something like 2,300 metric tons of gold from the U.S. They had dollars. Dollars were supposedly convertible at 35 of them to an ounce of gold. They had the dollars. They wanted the gold. The U.S. had what we have now, allegedly, 8,900 tons. That would have dropped us down to, 6,500 and eventually gone to zero, like Canada. Well, that dog wasn't going to hunt. So eventually this was going to happen. The important thing and the ramifications that come all the way to today is that in the 50 years since, we are untethered. Fiat paper money is backed only by, people say the ability of the government to borrow, to tax, full faith and credit of the government kind of thing. Well, that's fine as long as you have full faith. I mean, that you have to have confidence. If for any medium of exchange, Tom, if you don't have confidence in the value of that, then you're not going to use it. And that's, again, that you can take that all the way to today's headlines, and what's happening in Afghanistan or in the world. And these are significant events that are deconstructing confidence in the U.S. going forward. And so that's eventually where this heads, like all fiat currency regimes. Eventually, people lose confidence because they're printing it so fast. And that's something that, I guess my final point in this rambling answer, we've all seen either the charts of, what the mark could buy in Weimar, Germany, and, the pictures of the guy with the wheelbarrow full of them. And that's a hockey stick, man. It's really not even a hockey stick. It's like a rhino horn. You start out, slowly, devaluing, losing confidence, and then it just goes really fast at the end. And that day is coming, and we were all set on that path 50 years ago.
So I'd like to get to a couple of those points there, Craig, a little bit later, but maybe the first one I'd like to hit is considering this, mountain of debt that we have accrued since getting off the gold standard, and then basically doubled it in the last year and a half. How does this affect the rest of the world, considering all of these other currencies are based on this reserve currency that is the US dollar?
Yeah. Well, first, everybody listening should recognize the trick that the bankers have played with something called the US dollar index. Because when you hear on Bloomberg or CNBC, the dollar is stronger today, like as we record, the dollar's up 30 cents, and the dollar index is up 30 cents. Well, what's the dollar index? It compares the dollar versus a basket of other similarly devaluing paper currencies. Most of them at 57% weighting is the euro, but then you got the English pound, the Japanese yen, and you go down the list. So if the dollar is being printed at the same relative pace as all of the rest of these, which is what's currently happening, then relative to each other, they don't change. And so they're able to say, oh, look, the dollar is so stable. Look, nothing wrong here. The dollar's fine. Well, it's stable because all the other pieces of crap are being printed to infinity too. Do you know the ECB now has a balance sheet of it's over 8 trillion euros, which is like $9 trillion. The Fed just went over 8 trillion. Okay, I don't know at which point you reach that crisis of confidence, but as long as the ECB is printing just as fast, the euro is just as fast as the Fed is printing dollars, then relative to each other, they don't change and everybody claims victory. That's what, so that's, I guess, one of the first things to think about, when you think about the dollar. But what has always happened in the past, and this is what's happening here, to restore, let's go all the way back to the end of World War II. Okay, total destruction, total war, really planet-wide, except here in the US, right? Separated by these oceans. So if you're going to rebuild everything and restart the global economy after that type of conflagration, you've got to have that medium of exchange, something that has confidence. So at Bretton Woods in 1944, they come up with this idea that they're going to back the US dollar with gold. The US is whatever we had at the time, 25,000 ounces, or 25,000 metric tons, of gold. And each dollar was convertible at 35 to 1 to an ounce of gold. Okay, great. You know what? We'll use this. And so Europe begins to rebuild, and trade begins to take place again in the late 40s and the 50s, and it's all being done in dollars. And so all these countries eventually have a big stockpile of dollars in their foreign currency reserves. And some of them naturally said, we'd like the gold instead. And that eventually led to 1971. But the point of this is, the way this cycle has always gone, without exception, is you start all the way over here on your pendulum with a sound currency that inspires confidence for people to use it. And then gradually over time, you swing all the way over here where you have a fiat currency that inspires zero confidence. Where this process is taking 50 years plus, this process of the pendulum swinging all the way back can happen basically in a weekend. And so that's where eventually, this is headed. And that's why gold and silver should be a part of everyone's portfolio, not your entire portfolio. That's ridiculous. You look at what the stock market's doing. The Fed prints 120 billion a month. Some of it goes into the stock market. It gets multiplied and levered up 30 times. Look at the stock market since Biden was elected. It's a straight up 45-degree angle. Every time it hits the 50-day moving average, it bounces again. Well, why? Because there's constantly cash going into it. Okay, so you'd be foolish at a time like this to be just 100% in something. You don't know when the end is going to come, but you own physical gold and silver because you understand this pendulum thing. And that's a certainty. That's where we're headed. We just don't know when.
That's a great point there, Craig. So I got a question a couple of weeks ago from a listener, and I saved it for you specifically, from Christopher G. He asked, the global economy seems to be a run on debt-based system led by the dollar. If a foreign nation were to come out with a gold-backed currency, digital or otherwise, how would that affect the price of gold and its exchangeability?
Well, That's a multi-pronged answer. I mean, one, it is now just at your basic supply demand level. At some point, this is going to happen. Okay. I've thought now I think I first figured this out in about 2005 or 6, that why wouldn't the Chinese in the 21st century want that exorbitant privilege of having at least a regional reserve currency? They got 1 point whatever billion people. They, like the US, want to mollify, pacify them with free stuff, right? You don't want them all coming into Beijing at once, with pitchforks. That's trouble for the Communist Party. So you got to keep them got to keep them fat and happy. Just give them enough stuff, keep them, tamped down. If you're going to do that, you got to be able to print yuan, renminbi, whatever. And they don't really have that ability at this point, like the U.S. had beginning in, with the Great Society in 1968, forcing the close, guns and butter. We're going to fight wars and we're going to give all this away, and we can only do that if we can freely print the currency. So eventually, someone like China is going to, it just makes sense. Why wouldn't they, in a big picture, long-term thinkers that they are, that they'd offer something like that? Okay, well, now here's something. If you lost confidence in the current scheme, this U.S.-dominated scheme that's persisted now for coming up on 80 years, and you're looking for something that does inspire confidence, well, maybe you want to start using this new gold-backed currency, regional currency, whatever it is. Well, then at just the supply-demand level, you have less demand for your good. In this case, the good is the dollar. And again, that's, remember from Econ 101, you got your supply curve and your demand curve. And if you shift it, price falls. And so the value of the dollar falls even further. And that's how those, those pieces kind of fit together. Again, it's not like this is something where, the Chinese are going to offer this next week. Okay, maybe they will. But I just, the hardest thing I think that I have found in my decade plus of doing this and doing interviews and talking to people is this kind of normalcy bias that people have. There's really nobody left alive that remembers a time when the dollar wasn't the world's reserve currency, when the US didn't control the monetary system through SWIFT and the treasury markets and everything else. And so if you haven't ever experienced that, it's very hard for people to understand what that's like, because people, the only thing they know is so to actually look over the horizon and put yourself in a position where things are different is really hard for the average person to do. And so a lot of people just kind of whistle along thinking that tomorrow is going to be just like yesterday. Most of the time it will be, but the day is going to come when it's not.
Mm-hmm. So if something like that happens, Craig, how would it affect the price of gold and its exchangeability? Like if that was possible overnight, would gold shoot up, or, would that system take time to implement, let's say?
Well, it depends on the scenario, Tom, but it's very difficult to envision a scenario where gold is revalued at $1,200 an ounce. Mm-hmm. Just because on a base level, that'd be very deflationary. And I just can't see that happening. I think from any historical basis, gold gets revalued higher. Mm-hmm. Now, whether that's China, again, we're just in whether it's plausible or implausible scenario. Right. Whether China, some weekend comes out and says, we will now, we're on the offer and we will buy the world's physical gold at $2,500 an ounce. Okay, that could be a pretty quick reset, but it might be more than that. Because if you're going to be exchanging it, if you're going to be backing your currency, you might want to set that level even higher so that people can't just come running to you and demand the exchange, right? Mm-hmm. So I don't know. In that kind of scenario, it could be either. Again, I just don't think history argues that as all this stuff eventually plays out, that $1,800 per ounce is the correct price, especially given the way we've been fed, these derivatives and all these substitutes for physical metal for the last, 45 years. You're believed to be a futures contract is as good as gold. You're believed to be an ETF like the GLD is as good as gold. You're believed to be an unallocated account is as good as gold. Well, it's not. It's not. That's just leverage. And so if there's really less actual gold out there, that's going to impact things too. The people that think they own gold that all of a sudden can't get it, that's going to be a rush of demand too. So there are a lot of things that I would say certainly augur for a higher price when all this happens, certainly not a lower one.
Mm-hmm. So, Craig, as we keep getting these numbers that would traditionally be good for gold and bad for the general equities, like these staggering PPI and CPI prints, yet the reactions of the markets to them is let's say something that you wouldn't traditionally think of as that should be happening, right? So, is the only thing that matters at this point the Fed pumping more liquidity into the system?
Yeah, and the ECB. What's the problem with gold right now? If you want to look at it from the way, one of these 8-figure Wall Street guy, hedge fund managers look at, because again, these are the people that are buying the gold futures, right? And we know that the futures tail wags the physical or spot dog. It's the way it's always been. So the price of the futures contract is a function of supply and demand of said contract, right? So if you have supply, even if you hold that constant, but demand is falling, then like I said, just like the example of the dollar, then the price falls. Okay, well, why has demand been falling for futures contracts? Well, that's a multifaceted answer. But in its simplest form, you got these hedge fund managers, the people that would traditionally be buying it, that are either believing that the inflation thing is transitory, okay, and they believe, that negative real rates of 4%. Okay, fine. I'll buy my treasury at 1.5 and absorb a negative 4% real return this year because I think over the rest of the life of this note, rates are going to go negative or something. I mean, think about that. If you're going to lose 4% of your purchasing power the first year, and then maybe 2% the year after that, over the life of that 10 years, I mean, where do real rates have to go? Plus 1 or 2% for that to make sense? But yet that's how this has been working. And then getting it back to not only the actual carbon-based traders that buy and sell the futures contracts, think of the algorithms that are all set up. I mean, New York Stock Exchange, it's 85% on a daily basis is just computer trades, just swapping, GE and Microsoft and the rest back and forth. It's got to be as much as that, and COMEX and Globex as well. Well, those algos are all, or not all, I shouldn't say that, but it appears to me that most of those algorithmic trades are a program that one of their cues are the intraday tick per tick changes of the dollar index that we discussed earlier. So if the dollar index is going up, then you get this, this kind of constant headwind of these algorithms that are selling every rally and dumping their gold futures. And again, why is the dollar rallied over the last couple of months? Because there's this perception that the Fed is going to start slowing down their $120 billion a month, even if they cut it back to 100 or 80. Again, relative to the ECB, which is still full throttle, then all of a sudden, well, wait a second, the dollar's not devaluing as fast as the euro. So therefore, the dollar goes up on a relative basis and the computers sell gold. So I don't know. You could say, well, you're just raging against the machine. In a sense, I am. I just, the smartest thing people can do is just continue to use those prices to your advantage. I mean, look, I've been buying, I think I bought my first ounces of silver in like 2009. I was buying it through 2010. I bought some at 40 plus in 2011, but I bought so freaking much between 13 and 18 when the price was, between $14 and $18. My personal cost basis is not like 17 now. So really the only thing people can do for their physical standpoint is just keep averaging in, just keep buying more in recognition that this can't go on, that this whole system can't go on forever.
Yeah, it's something that we've hit a couple times on the show is that this none of these, let's say, short-term speed bumps really affect the long-term thesis of gold and silver.
Right, no doubt about it. Mm-hmm. No, and really you can even, the chart has taken some damage as of late. That smash, regardless of who people might believe was behind that, back on Sunday, the whatever that was, the 8th of August, mm-hmm. That smash did a lot of damage to the chart which again makes these even some actual people traders get bearish and sell the rally, and you're below the key moving averages, and so the machines sell and all that kind of stuff. I mean, whatever. I mean, gold doesn't go straight up, uninterrupted uptrends, and it doesn't go straight to zero in some uninterrupted downtrend. So that trend will change too. And the important thing is to kind of have some experience and be watching so that you can kind of see what's happening and recognize when the trend is changing. And right now, actually, the chart in gold is getting more interesting by the day after that washout. Silver too. So this is a time to maybe be paying attention again.
So exactly as you point out there, Craig, on a recent update on your channel, you talked about the gold market recognizing something and it moving all at once. So what was the last example of this, let's say last June, and what kind of move was the result of it?
All right, so this is really important because I talk about my experience of people, with their normalcy bias or recency bias and not being able to contemplate, history and stuff like that. But you've got to, okay? And the same thing is true in the metals. If you're trying to trade or stack, or if you want to own the mining shares, you've got to anticipate. The last thing you want to do, is wait until 90% of the next move has taken place. And then, oh, hey, I finally feel comfortable. So that's where some experience, and having, be able to recall how these things have happened in the past can really work to your advantage. So that's why I try to share at my site. I would just remind everybody, first, big picture, nothing has changed, right? Over the last 10 years, everything, it's only sped up. I mean, we're now at $30 trillion in US debt, right? The US paying $450 billion a year in interest on that debt because they've been able to jam the total average duration down to 1.5%, a couple of years. Okay. They cannot allow rates to go higher. And the Fed in the past has, as an example, run sharply negative real rates for a decade in the 40s and 50s as a way to try to inflate your way out of, the huge debt burden versus GDP. Nothing has changed in that regard. It's only worse in the last year, but for the reason we just discussed, prices fall. So if nothing has changed fundamentally, then how, you got to start looking for some signs. And I would remind everybody, I mean, it's only a year ago, but it's been such a challenging year that, people don't want to remember or can't remember. After COVID hit and the lockdowns and the markets were collapsing, and on whatever day it was, March the 23rd of 2020 at 7 a.m, here comes the Fed with $120 billion of QE, all this alphabet soup of all these new facilities that they're going to try to run. They're going to start buying high yield bonds and corporate bonds, all these plans to rescue things and flood everything with liquidity. And you got all the stimulus and, you name it. All that stuff was done. Well, gold and silver, remember, immediately come back from what had been a total liquidation of the futures markets. Remember, silver went to 12. You couldn't buy it for less than 25 or 6, but the futures market was trading at 12. So anyway, you get this recovery. Gold moves back up to new highs versus where it was earlier in the year. It goes through 1580, where it kind of topped out in 2019 and in January and February of last year, but then stalls out and spent April until maybe early July, about 100 days, trading kind of where it is now, between 1680 and 1780. In fact, after the jobs report of June the 5th, 2020, it tried to break down out, got to like 1671 and then reversed. I mean, it looked like, oh boy, here we're breaking down. This is not good. And then it reversed. Well, then once it broke out above 1780, and broke out of that range, it went from 1780 to 2080 in about 6 weeks. What's that, 15%? Silver was even worse, man. People on my site were pulling their hair out. How could silver not be going up? They're printing all these trillions of dollars and silver is still in this range. Silver had been in a range that I mentioned earlier, from basically 14 to 18 for 6 freaking years. That's a lot of producers, miners, traders, hedgers, banks, you name it, that had gotten accustomed to an average price of 16. And it's sitting there all the way through June and into July, still unable to get above 18. Then all of a sudden it goes to 19, 20, breaks above 20. I remember, wow, it's back to 22. Holy cow. And it went from 18 to 29 in like 3 weeks. Okay. So there's precedent for this grinding that we're seeing at present, there's also precedent for the market to suddenly just like wake up and just explode higher like it did last summer. Now, when's that going to come? I don't know, but it's very likely to be coming again. And one last thing to talk about silver. Again, I mentioned, rattle off all those different silver market participants in the futures market, but even the physical market that got accustomed to this basically $16 price that held for 6 years. Boom, we shoot up. And now it's been what? Maybe the average price has been 26 for the last year, 25 maybe, because we've been between 22 and 28. Well, it takes a little while for everybody in the market to get used to that, and go, oh, I guess it's not going back down. And so you kind of have to have everybody kind of adjust a little bit. And, technically on a chart, technicians would say, yeah, you spike up, you get a consolidation flag, and then you measure the flag, how much it's going to go. Because the flag ends, if the trend continues, the flag ends, with this kind of measured move up from there. And I just, again, the trend is continuing. So when the flag ends, I don't think it's going to be a 6-year consolidation and a 6-year flag. I hope not. But I still think the trend's that direction. So everybody just needs to kind of, again, maintain that longer term picture and continue to use this time to your advantage.
Mm-hmm. Craig, you had mentioned that the Fed, there's no way they're going to actually, raise rates or relatively taper. So as we're waiting for, let's say, the FOMC meeting next week, how do you look at the announcements that might come out of this? Are there any threats of actually, moving in what would be considered a positive direction for, raising rates or tapering relative to what the amount of QE that they've been pouring into the market right now?
Well, this is a lot like last year too, Tom. What's a week from, I think, this coming Friday, the 28th, is I said the Jackson Hole thing that the Fed or Kansas City Fed sponsors, and all these people fly into Jackson Hole, Wyoming every year. That is the 26th to the 27th to 29th, Thursday to Saturday. So I think, I haven't seen yet, but I think Powell speaks on Friday. Usually he does that kind of stuff on Friday. So in anticipation, people are expecting some kind of, announcement as to what they're going to do regarding taper. And then, as you mentioned, the September FOMC is when, maybe pen will be put to paper and they'll actually tell you what they're going to do by December or something. The same thing happened last year. We started getting trial balloons in late July. An infamous one was from Bloomberg on July the 19th. It was a Friday. It came out about 5 p.m. Eastern, that said the Fed is getting ready to announce a change in how they're going to handle their interest rate policy. And rather than immediately trigger a tightening if we get to 2%, they're going to start averaging inflation, to give some wiggle room. And they even said in that article, eventually this will lead to yield curve control too, but they're going to have a longer term time horizon with inflation. Well, guess what? Those are your trial balloons. There was a second one that came from the Wall Street Journal a couple weeks later. And that's exactly what Powell announced at Jackson Hole. And that's exactly what they formalized in September. Mm-hmm. Okay, so now fast forward today. It was, I think, just yesterday. Yes, it was yesterday. That here's your trial balloon. Wall Street Journal, mouthpiece at the Wall Street Journal, comes out and says the Fed is planning, Powell is planning at Jackson Hole to begin to announce the taper plan and where they're going to go from here. And so that's coming. That's coming next week. And then you're going to, and it's going to be, dependent upon expected, further improvement, and all this other, garbage that they put on as caveats. But that's coming next week. They're going to announce it. What I don't want to say banking on, what I'm expecting is that since this has been discussed, really since the June FOMC, and the dollar's rallied from 90 and a half to 92 and a half, 93, I think this whole thing beginning next week, and then as it gets laid out at the September FOMC in the middle of the month, is actually going to be for the dollar, buy the rumor, sell the news, and for gold, sell the rumor, buy the news. Because I think they're going to kind of crab walk this thing. We'll think about starting to taper in December, and then we're going to start with the mortgage-backed securities, We'll drop that back to 20 billion. It'll be something like that where the market will go, huh? And then with the COVID lockdowns that are getting worse again, the economic data, even this week has been lousy. Last week was lousy too. They'll come up with reasons to kind of keep pushing it back because again, without the Fed buying $1 trillion, $960 billion a year of treasuries, well, who is going to buy them? We just heard yesterday, China's cut back another 40 billion of their treasury holdings the last 2 months, and rates have fallen while they've been selling because the Fed is the bid. And again, they can't afford to have rates go higher, not just on, the interest on the national debt, but municipal debt, state debt, personal debt, mortgage rates, credit card rates, all that. I mean, they can't afford it. So the Fed has to continue to be the last resort. And so that's why I think, again, that's my basis for this idea that, excuse me, as this news filters out, whether it's more trial balloons or Powell's actual speech next week, it's going to end up being the dollar actually declines, kind of, again, a buy the rumor, sell the news, and that should impact the metals positively, start turning the chart, getting it look better, and start getting some positive momentum.
Mm-hmm. So as you mentioned all of these different factors that are going to play into be able to be crab walking this thing sideways, mm-hmm. Do you think that there's any possibility that this fiscal and monetary cliff, these payments that are being sent out, do you think there's any possibility that actually comes to an end, let's say in, I believe in January?
Well, you mentioned that's another thing that's kind of overhanging the market. I mean, the debt ceiling is a joke, right? Mm-hmm. I mean, back in the day when they first passed it, whatever it was, 30 years ago, it was a ceiling of actual debt. And the Congress, would say, okay, well, we can't let the debt go past $4 trillion. And then, a couple of years later, we'd get to 4 trillion, and then they'd have to vote and extend it to 6 trillion. And then a couple of years later, anyway, back in 2009 and 10, we started, they'd bump it up $1 trillion, and then bang, we'd be right there again, like 6 months later. Mm-hmm. Where people are like, wait a second. And so Congress, being the charlatan trickmeisters that they are, said, hey, here's what we're going to do. We're going to change the debt ceiling, and we're going to make it just a date. No more of these numbers. Okay. We won't tell anybody. And so the debt ceiling now is just a date beyond, because if every time they came back and said, well, we're not going to go past 30 trillion, wait, now you're 30, it'd be constantly in the headlines. So now it's just a date. Well, the date's going to expire again at the end of the US fiscal year on September 30th. I think it's October 1st, the date expires. Okay. So the Fed the Treasury has this cash balance of all the cash, they've been selling bonds, the Fed's been buying them, they build up this war chest, they've been cutting checks to people and spending it out. Well, anyway, now if they can't issue more debt because they can't go past a certain ceiling from a date standpoint, well, then the Treasury is going to have to start using that cash balance. And I saw a chart where that's going to trickle down. That's why I keep doing this with my finger, down to zero. The cash balance is going to go to zero by early October. So even though it's a charade, even though it's theater, this is a little something that, is going to ripple around after Labor Day here in the US, which is another reason why the dollar might get kind of weaker. So you put all that back together, price has been compressed so far down in the metals. No trend is going to take it to zero. Like I said, every upturn is not going to infinity, so it's going to break. Every downtrend is going to break as well, and the signs are there. We've got these double bottoms on the charts of both metals. You start moving up now, okay? Get back above the 200-day moving average in gold. Get back above 1840, but then get back above 1920, and people are going, oh, look at this, a series of higher highs and higher lows, and and the thing just boom, and then boom, takes off. I mean, this is what's going to happen. It could happen before the end of the year, but because there are all these factors out there. Maybe it won't happen. I don't know, but it's going to happen eventually. So there are all these things that are out there. That debt ceiling thing is just another. And Tom, I can't remember why this all ties together to your question because I've been talking for so long, but it's another thing that's going to impact things in the weeks ahead.
Mm-hmm. Well, you and I have talked about confidence several times today, or mentioned confidence several times today. And as I'm sure many of our listeners are aware, or they might have seen, Biden's statements that Afghanistan won't fall just over a month ago, like at the beginning of July. So does this start to play against the confidence in the administration here?
I don't think there's any doubt about it. could it have been, of course, things could have gone differently, right? And so, every U.S. president since, the second Bush has talked about getting us out of Afghanistan. And every armchair general's got an idea of how it could have been done better. Well, that's pretty easy because it couldn't have been done worse. But the important thing here, again, is now the big picture, all right? And we'll just go back to something we talked about earlier in this discussion, which was the U.S. being established as the reserve currency of the world for the post-World War II era, because there was nobody else. Okay, nobody else had the manufacturing capability, the stability, the rule of law. We knew what it was, right? All these countries were rebuilding. You didn't know where they were headed, all that kind of stuff. So there was a rationale for putting confidence in America and letting America control, really, the world's financial system. Okay, all the way up to like the petrodollar scheme, right? And getting the Saudis and all the OPEC nations to price energy in dollars, thus creating constant demand for dollars, because energy is the most important commodity in the world. And, keeping this demand for dollar, keeping the value up. All these things were pieced together that way. You've got to have confidence. People have to have confidence in the U.S., or they will not have confidence in the U.S. dollar, and by extension, the entire U.S. dollar-based monetary system. And when that confidence, erodes, then it's just, you're just picking away at the system the whole time. And so again, think of all the ways that the U.S. controls the monetary system, whether it's the reserve currency, this exorbitant privilege. Remember Secretary Connolly saying it's our dollar, but it's your problem. Okay, whether it's that, whether it's the SWIFT system, the international payment system, that the U.S. has the power. Hey, we don't like what you're doing. We're going to kick you out of SWIFT, and now what are you going to do? Well, okay, that works for a while, but then sometimes countries don't want to play along and they want to establish something outside of that. Whether it's the treasury market, in the 10-year treasury that acts as the benchmark, foundational investment for hedge funds and institutions and even governments around the world. All of those things are a function of confidence that the U.S. is going to be responsible, that the U.S. is the leader, that the U.S. stands by its commitments, that the U.S. is going to be there for you in a crisis. And man, events like this really we saw something. I just saw it. We're recording this on Tuesday the 17th. There was a thing in the South China Morning Post, I think it was today, or one of those CCP mouthpieces that was essentially warning Taiwan, and said, hey, look, man, U.S. may say they got your back, but if we invade, you really think they have your back? And do we really? We've always said we would, but do you really think that there'd be backbone not only in the administration, but within the American population to have like a nuclear war with China over Taiwan? Nothing currently would suggest that there'd be any support for that. So if you're the Chinese, maybe you play that card at some point. And again, these nicks at that confidence is what lead to all these cascading series of events. And so what happened this week, it's tragic. It's terrible. It's just awful. And so many things went wrong, but there's even an even bigger picture that this is a part of it. That's all very troubling.
Yeah, I think an important point that you made there, Craig, is just that this is a bigger loss of confidence in the international community, not just in the U.S. Right.
Right. No doubt about it. No doubt about it. And it does lead to just more strife. Like we need more strife here in the U.S. Mm-hmm. Right. But man, again, Biden didn't start that deal, and there are plenty of things that Trump did that he completely unwound right away, right? Trump was getting people getting the U.S. out of this climate change accords and all that kind of stuff. Biden could have said, nah, we're not going to do that. We're going to negotiate something else again. We've had troops that we fought to a stalemate in Korea 80 freaking years ago, 70 years ago. I take that back. We still have 25, 30,000 troops in Korea. They don't do anything, right? They're just there. We got troops in Germany still. We got troops in Okinawa. Okay, well, why can't we, again, now I'm the armchair general, right? Why couldn't we have kept 5,000 troops at Bagram Air Force Base? They didn't have to do anything. You just get rotated in and out of there every 9 months. I don't know. But Biden's going to wear this one. And we'll see what that means. We got another set of elections coming up in the U.S. in 15 months. We'll see, where it goes from here.
Mm-hmm. Doesn't instability like this typically bode well for the metals, Craig?
Typically. But again, I mean, there's, we always joke about, a nuclear bomb could go off in New York City and the metals would go down, right? Well, if the dollar rises, the machines would take the metals down, right? And again, it's a function of the futures tail wagging the spot dog. What drives the futures? If human traders don't want it, then you're left with just machines. The machines are going to track the dollar in the bond market, and the dollar is a function of, relative to all this other fiat. So under this current scheme, who knows anymore? That's what's so maddening. And again, I refer to this current scheme, and this was put in place right after Bretton Woods too. Right after Nixon closed the window as well. Maybe I'll send you, Tom, you can include the link. WikiLeaks uncovered 5 or 6 years ago a cable from December 10, 1974, from the Secretary of Treasury in the UK to the Secretary of State in the US, saying that they're going to form a sizable futures market that to the dealer's expectation would be so freaking volatile that it would scare people away from wanting to own physical metal. Mm-hmm. Okay, well, looks like that's still working, doesn't it? And that's all. That's the current scheme that we have, the pricing scheme. We're trading these derivatives that act as some sort of synthetic, make-believe, digital, gold promise rather than the real thing. And there's some cracks in that system that are definitely showing. Man, last March was a fissure that they've been able to stitch back together. But one of these days, we're going to have to get to the bottom of it. And the world's going to have to show their hands as to who actually has gold and who doesn't. The real thing. And personally, I've got the real thing, and I'm prepared for that moment. And that's what I encourage everybody at TF Metals Report. That's what we encourage to keep preparing for.
Excellent, Craig. Well, I think we've covered a lot of topics here today. Is there anything else you want to add before we wrap up here?
Well, let's just watch where price goes going forward. If you're a trader, or if you own the mining shares, watch silver specifically. Here's one last tip for everybody. If you're owning the mining shares, I know you discussed that, Tom, quite a bit, and you're pulling your hair out. Why aren't the shares? Gold's bouncing back, and the shares aren't doing anything. Go to a free. You can do this for free. This will take you a grand total about a minute to do. The chart I used for comparative charts called barchart.com. Go to barchart.com. Pull up a chart of silver futures. Okay, that's anybody can navigate around, figure that. Click on an interactive chart, plot silver futures, and then type in there a comparison to lay over the GDX. Now, the GDX is a large cap producing gold miner. The hell does that have to do with silver? Nothing. I mean, really nothing. Some of those gold miners kick out a little silver. What does that have to do with anything in the grand scheme of things? They're kicking off free cash flow, all this jazz. They should not be correlated. But I invite you to plot the two together. Note the correlation, not just 6 months or even 6 years. Go back 10 years. And note that they're tick for tick. If anything should demonstrate to people what I've told you about the computers and the algorithms and the HFT program trading influencing things, it's that. I mean, it is probably a 95 to 98% correlation between silver futures and the GDX. So that would be my final tip for everybody. Understand that the price you see is really kind of bogus for just about everything. It's just the computers trading things based off liquidity and these relative valuations that are all kind of silly to us as humans, but not to the computers that have been programmed by humans that want them to do a certain thing. So you want your shares to rally, and they will. Let's at least get silver to go up. You look at the chart of silver, it double bottomed at 23, it looks like, in the last week. It had double bottomed at 24. or it kind of double bottomed at 22 in November, went at 24 and bottomed in March, double bottomed again at 23. I think this is pretty stable down here between 24 and 22. Get back above 24, you start targeting 26. And man, if and when it ever gets above 28 on a consistent basis, that's when you get that move again like we got last year. So just be prepared for that. Watch that, understand that correlation, and then just kind of prepare yourself accordingly.
Excellent, Craig. Well, I really appreciate all your thoughts and your advice here. Of course, you're available on Twitter at TFMetals and tfmetalsreport.com.
Right there.
Excellent,
God,
Craig.
Tom, geez, 11 years? I don't know. All I know is I was a young kid when this started, and now I'm just this grizzled old fart. There are dog years, right? And cat years, horse years. There are gold years.
I was going to say, yeah, gold years.
Yeah. But yeah, what we do, it's a great site. And I encourage people, it's not just what I do, it's everybody else on the site and the value that they provide that you want to interact with. And so please check us out. It's I'm really proud of it.
Excellent, Craig. Thanks so much for your time today.
Tom, my pleasure.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.